Your savings account feels like the safe choice. It's the responsible place. The money you're not gambling, not spending, just keeping safe. But here's the uncomfortable truth. For most people, that account is quietly losing money every single year. Not because anything dramatic happens, because of two forces working silently in the background. By the end of this video, you'll see exactly how an ordinary savings account leaks value, how much that leak really costs, and the simple, boring fix that keeps your cash working instead of shrinking. Let's start with where most money sits. You get paid, you cover your bills, and whatever's left lands in a savings account at the same big bank you've used for years. It feels prudent. It feels like you're doing the right thing. And in one sense, you are. You're not blowing it, and the money isn't at risk. But open your account and look at one number almost nobody checks: the interest rate. At a lot of the biggest banks, a standard savings account pays something close to nothing. A tiny fraction of a percent. On $10,000, that can be $1 or $2 for the entire year. That's not a typo. A couple of dollars for a whole year of your money sitting there. And meanwhile, the price of everything you buy keeps creeping upward. That's the part that quietly turns safe into shrinking. Here's the idea the whole video rests on. Money has one quiet job while it sits still: to hold its value. Every year, inflation, the slow rise in prices, chips a little off what your dollar can actually buy. Historically, that's averaged somewhere around 2 to 3% a year. So if your cash is earning almost nothing, while prices rise 2 or 3%, you're not standing still. You're going backwards. Your balance on the screen looks the same, maybe a few cents bigger. But what that money can buy at the store is shrinking in the background. That's the silent tax nobody sends you a bill for. And it's exactly why a savings account paying near zero isn't really safe. It's a slow, almost invisible leak. Let me put real numbers on it, because the gap is bigger than it feels. Picture $10,000, a solid emergency fund, sitting in a typical big bank savings account paying, let's say, 0.01%. After a full year, you've earned about $1. Now imagine that same $10,000 in a high-yield savings account. The same kind of account, the same safety, just one that actually competes for your money. In recent years, those have paid somewhere in the neighborhood of 4%. 4% on $10,000 is roughly $400 in a single year. Same money, same risk. One earns you $1, the other earns you a few hundred. That isn't a rounding error. That's the difference between your cash treading water and your cash quietly pulling its own weight. Now stretch it out. Leave that gap in place for 5 or 10 years on a growing balance. And you're talking about thousands of dollars you simply left on the table, handed in effect to a bank that was counting on you not to check. So why does the big bank pay you almost nothing? Honestly, because they don't have to. They know most people never move their money. The account is convenient, it's familiar, and switching feels like a chore. So the bank quietly takes your deposits and lends your deposits out at far higher rates while paying you a rounding error. That's not a scandal, it's just the business they're in. But it does mean the gap is yours to close. Nobody's going to call you up and offer to start paying you $400 instead of $1. You have to go and get it. Now, the first reaction most people have is suspicion. If it's the same safety for many times the interest, what exactly is the catch? It's a fair question. And the honest answer is that there mostly isn't one. The banks paying these higher rates are usually online banks, or the online arm of a familiar bank. With no expensive branches to staff and light up on every corner, their costs are far lower. And they hand some of that saving back to you to win your deposits. Your money still sits in a real, regulated, insured bank, protected up to the very same legal limits. So you are not taking on some hidden risk to earn more. You are simply refusing to keep paying for a marble branch lobby you never actually walk into. The only real catch is that you have to bother to make the switch, which is precisely what the big banks are quietly betting you will never get around to doing. So here's how to actually fix the leak, in a few plain steps. Step 1. Find out what your account really pays. Log in or check a recent statement and look for the interest rate. It's sometimes called APY, the annual percentage yield. If it starts with a 0 point something, that's your signal. You're earning almost nothing, and you can do dramatically better for the exact same safety. Step 2. Understand the safer high-yield options as a category. Not any one brand. A high-yield savings account is the simplest. It works just like a normal savings account, but it pays many times more, mostly because it isn't paying for a chain of expensive branches on every corner. Money market accounts are a close cousin. The key point is that these aren't risky exotic products. They're ordinary savings accounts, just ones that actually pay you something. Step 3. Before you move a single dollar, check the 3 things that matter. 1. Is it insured? In the US, that means FDIC insured, so your money is protected up to the legal limits, even if the bank itself fails. 2. Are there fees or a big minimum balance that quietly eat your gains? Favor accounts with no monthly fee and no high minimum. 3. Can you get your money out easily with quick transfers back to your checking account? An emergency fund only works if you can actually reach it fast. Step 4. Keep it boring and watch for the catch. Don't obsess over a tiny difference between one good account and another, and be skeptical of a flashy teaser rate that's only sky-high for the first few months and then quietly drops. Pick a solid, insured, no-fee account. Move your savings over once, and then just let it run. The goal here isn't to outsmart anyone or chase the perfect number. It's simply to stop volunteering to lose money. One last thing. So you put this tool to the right job. A high-yield savings account is perfect for money you need to keep safe and reach quickly. Your emergency fund, the cash for a goal that is only a year or 2 away, the buffer that lets you sleep at night. What it is not built for is money you will not need for many years. Cash that simply sits, even while earning a few percent, still only barely keeps pace with rising prices over the long run. It protects your money beautifully, but it does not truly grow it. Money you can afford to leave completely untouched for a decade or more has a different and far more powerful job it could be doing. And that is the whole story of the next video. For right now, though, the win is simple and worth doing today. Get your safe money out of the near zero account and into one that actually pays you to keep it there. So here's the whole thing in one breath. Cash sitting in a near zero savings account isn't truly safe. It's slowly shrinking, because inflation quietly outruns the few cents of interest you're earning. A high-yield savings account gives you the exact same safety and liquidity, but it actually pays you, often the difference between $1 a year and a few hundred. And the fix is a one-time, boring afternoon. Check your rate, find an insured, no-fee account that actually pays, move your money over, and stop the leak for good. Your emergency fund's real job is to be there the moment you need it, but there's no reason it can't quietly earn its keep while it waits. If this made you want to go check your own rate right now, good. That's exactly the point. Subscribe, because the next one breaks down index funds, the boring, almost embarrassingly simple way most everyday millionaires are actually built. And one quick reminder before you go, this is general education, not financial advice. The rates and numbers here are simple illustrations that change over time, not a quote or a promise. So do your own research, and always check an account's current terms before you move any money.